Hi, everybody. Welcome to Stop Being Sold, a community of informed consumers who are sick and tired of being sold financial products they don't understand or need. So if you're tired of being a transaction, go ahead and hit that subscribe button and also the notification bell so you never miss another video from us. How are you today, Brian?
Hey, Michelle, I'm doing great. How about yourself?
Good, thank you. So today's video, we're going to be talking about indexed universal life insurance. So what it is, how it works, and who it's for. I think this is just meant to be an explanatory video for anybody out there who's currently shopping for life insurance, or if you already have life insurance and you're not exactly sure what you have, this might be the video for you to watch to the end.
This may be the video for you to watch.
Exactly. Understand what you have is the name of the reason why we exist. So I'm going to toss it over to you. What is indexed universal life insurance?
Okay, that's a big, long word there, right? Indexed universal life insurance. So we're going to break it down. There's three main words in this, and I'm going to break them down in reverse, okay? First, there's life insurance. That's simple. We all know what life insurance is. But indexed universal life insurance is or another name for it is IUL. You may see that in articles, or an advisor may speak about an IUL policy. That's what it is, an indexed universal life policy. So what it is, Michelle, is it's a type of permanent life insurance, which means it has a cash value component in addition to the death benefit. Okay. So that's word number one, life insurance. Second,
and it's also a type of permanent life insurance, not term. Okay.
Yes. Second word in there is universal. With being universal, the IUL has options that allow you to change, like the amount that you pay for the insurance, your death benefits, and how much cash value you want. So it's allowed to be changed during the process. You don't see that in a term life policy, right?
Right.
Okay. And the third word in the title is indexed. So in a standard universal life policy, the cash value is guaranteed to grow at a fixed interest rate, whether it's on the current market conditions or the minimum interest rate, whichever is higher, right?
Okay.
With an IUL, though, it's a little bit different. The money in your cash value account can earn interest based on a stock market index chosen by you and your insurer, such as the S&P 500, the Nasdaq, the Dow. So funds don't earn a fixed rate of interest, but typically come with an interest rate guarantee.
Okay. Got it. All right. So the money in your cash value account earns interest based on the stock market index that you choose.
Right.
Okay. All right. So how does it work?
Okay. So let's start with when you make your IUL premium payments, when you pay into the policy, a portion of them funds are taken out for the cost of insurance, because it is a life insurance policy, right? And then they take out for any fees or expenses that the insurance company charges, which there are multiple fees. And whatever's left of that premium payment, Michelle, goes towards a chosen index or indexes that year for growth. So like the Dow or the S&P 500. So we've explained this before in indexed annuity videos that we've done in the past. So this is going to be very similar to that. Each year, if the indexes are up in value, you receive a positive gain in your cash value up to what the cap is, or what the participation rate is, minus any insurance expenses. Trust me, the insurance company is going to take out their expenses first.
Right, first.
So remember that. But if the indexes are negative, Michelle, you don't lose any of your current cash value, but the insurance charges still come out. There's where you have to be careful. If you don't have cash values left in that policy, you may have to increase your premiums to cover those costs or risk the policy lapsing. There is a gotcha inside of here that you got to remember.
Okay, so let me recap this. So if the indexes that are chosen go up in value, you're going to obviously receive a positive gain, right? You get that money, the insurance money takes out their fees and whatever it is, and then whatever's left, okay, great, goes to you. But if it's under, if like you incur, like if the indices, is it indices? Is that how you say it? Are negative, what will happen? The insurance will take their portion out.
Right. Because the
If you don't
fees
have
are
any
always going
cash
to be.
value. If you don't have any cash values left, it may pump up your premium.
Yeah, there you'll get a notification from the company saying, hey, we need more premiums to cover the cost of the insurance. Your index is underperformed for, let's say, several years in a row. And
Okay.
we've depleted your cash value because our fees still have to come out. The insurance company's fees still have to come out. So
Okay.
I've seen this very frequently.
Okay. So then one of my questions is, if that's a gotcha in here, like why would someone even want universal or indexed universal life insurance?
No,
Let's do this. Maybe take us through what the benefits are.
Yes.
Because that seems like a really big gotcha.
It is a gotcha, and you got to be careful with it. These policies are made for specific circumstances, but sometimes they're sold to way too many people. Okay.
Well, my concern too is like you can't control what the S&P's doing and 500's doing, right?
No,
but
Nasdaq, you get gains up to your caps. Now, in good years, these policies have performed very well.
Got it.
But the fees are also always going to be there, so you have to remember that. So,
okay,
let's hit some of the benefits and the advantages of the Index Universal Life policy, and that may help you understand why you purchased it, or if you're looking at purchasing one, you may fall into one of these camps as pulling out one of these benefits of why you actually want one. So first of all, Michelle, they offer flexibility. Okay, it's not like a typical term policy where it says, okay, here's your $250,000 term policy, $30 a month, 30 years. There's your plan. You can't change it, right? Okay, with here, you get flexibility of changing stuff inside the plan, but also you can gain higher interest rates than other kinds of life insurance. Right. One of the most attractive features of an IUL is the ability to take advantage of stock market returns without the risk of loss, because this is not a variable universal life policy. This is just an index universal, just like an indexed annuity. It's built on that same type of chassis. And also, Michelle, you get to build up a death benefit that your beneficiaries can also receive tax-free, where you can't do that with some normal investments, unlike a Roth IRA.
Right. So you have control with the indexed universal life. You have control over your death benefits and payments.
Yes. And your payments.
Flexibility and payments. Okay.
Okay. So, and think about this. You have the flexibility to increase or decrease your payments depending on your need for coverage and the growth of your cash account and your financial situation. So you can change this stuff during the plan. You can't do that with a typical term life insurance policy without changing the whole plan. Does that make sense?
Okay. All right.
Also, stock market index driven rates of return on your cash value account. Okay. So look, we all love returns in the stock market. If you can do that inside of a guaranteed policy, most insurance policies are built on like a fixed rate chassis. This allows you to gain while the market grows also. And that growth is accumulating tax-free inside the IUL policy. So the index-based options can outperform fixed interest rates and in other types of permanent policies, and it gives you the potential to grow your cash values even faster, but you're also limiting your downside risk, because in the years that the market's down, you just get a zero return for that year. Yes, you still have to pay the insurance fees, but the growth of some of these policies have been pretty substantial, especially in the last, I'd say 5-7 years. We've had some pretty good returns in these type of policies. So.
Got it. Okay.
Okay.
What's another benefit?
Here's a big one: unlimited contributions. So unlike your tax deferred accounts, like your 401ks, IRAs, you ain't got no limits in these policies on the amount that you can put in. And then to follow that up, go one step further, you're talking about tax-free growth and distributions. Okay. Inside these policies, they talk about the loan features. Okay. They use the loan features to allow you to take withdrawals from your IUL, and your distributions are then considered tax-free.
Okay.
Very big benefit there. Okay. Let's go one step further. No age limit for withdrawals.
So like Unlike the IRAs and the 401ks where you have that set thing, there's no limits on this one.
So imagine somebody in their 40s needing access to pull funds out of their IUL for first-time home ownership. Yes, you have that provision inside a Roth IRA, right? But what if you needed more? And now you'd be hit with penalties, with IRA accounts, 401k accounts, that kind of stuff. Here, you can pull out the distributions without them limitations. So,
okay.
And then another benefit is the tax-free death benefit to your heirs.
Oh, okay.
And that also includes the cash value built up inside the policy, Michelle.
Interesting. Okay. All right. Well, those are some advantages. Seems like I can see what people, now I should have kept my mouth shut. I asked why would people.
No, that's good though, because people are asking this stuff. So
this is, no, I mean, but I was actually I understand if this is your situation, your specific situation, allows for this, or if what do you want it for? Right. That's really what it goes back to. Anyway. All right. I'm going to stop rambling. What are some of the disadvantages?
Okay. One, we talked about this in the beginning. We talked about, in the down years in the market where you still have to pay them fees. Okay. So that risk that the stock market will not rise as quickly as the illustrations have been shown. And an illustration is basically, when you purchase a policy, the insurance company and the advisor is going to run an illustration based on projections. Well, then projections, I've seen projections that were just way out of the ordinary. You can't look at past performance to be able to do this. You need a safe illustration, 4 to 6% in that range. I've seen projections and illustrations 12 to 15%.
Oh, wow. Okay.
So now think about that. If the return on your investment could fail to meet your goals, which could lead to you owing extra money to keep your policy from lapsing. So that risk that the market doesn't perform, we've had great years, since the 2008, 2009 crisis, right? Well, what if we're starting another era of a downturn of the market?
Absolutely.
That risk is going to come into play. So you have to be careful on that. So,
okay.
Another risk is the complexity of these policies. It's not like a term life insurance policy. It's that simple. You could term, exactly how much you're going to pay, exactly how much you're going to get, or your family will receive if you pass away. Okay. These policies here will take work to maintain your cash values. You got the years of underperformance of the indexes, and you may have to pay more in premiums to maintain it. So, but think about this. Each year, you're going to have to go through these illustrations and make your changes to your allocations. What if you bought the policy from your advisor and the advisor is now no longer around?
Right.
So that could be a problem. So
you do have that every year. I mean, we talked about the flexibility of these and the various ways that they're flexible, but even within the policy, you are every year going through your allocations and making sure you need to make adjustments, or someone needs to make adjustments.
You're exactly right.
But the downside would be if you were working with someone who sold it to you and they're no longer around, it's up to you to do it.
Right.
Okay.
And if you didn't know enough about it, it's not your job to go understand how to do your policy each year and keep up on it. So you'd be making phone calls to insurance companies who would say, go back to your agent. Agent may not be there any longer, or know enough about it to make them changes. Right. So, okay. So that's some of the negatives.
Are there any other disadvantages?
Yeah, a limited upside. Okay. These are based on indexes. Okay. But you're capped on your returns based on the index caps and the participation rates that are inside the policy. This means that you don't get all the upside potential of the S&P 500, but only amount up to what your cap may be. Very similar to indexed annuities. These caps can also come down over time. Each year you get that statement, it might show that, your cap's a little bit lower, a little bit lower, a little bit lower. And that could further limit your cash value potential growth inside the policy.
Got it. Okay. All right.
Also, one more quick thing. The fees could be flexible also depending on the policy. They're not always just standard fees. What you see is one fee that could be a flexible fee is the cost of insurance each year. Well, what happens each year as you get a new statement? You're 1 year older.
Yeah.
Well, guess what? Your cost of insurance is now 1 year higher of premiums. So the flexibility works. Unlike a term policy, you pay the exact same amount based in for 30 years or 25 years, however long you have that policy for. The cost of insurance could continue to go up as you get older each year. Just remember that. So,
okay. All right. Well, then last question I really have is, who is indexed universal life insurance good for? Who's this a right fit for?
Yeah. And that's it. It comes back down to the fit. Who does this fit? First of all, Michelle, you need someone that has a long-term goal with this type of policy. And here's my scenario. We've had people call the office over the years saying, hey, my friend got one of these. I want to buy one of these. Mm-hmm. Great. Here's your premiums. Can you tell me today that you can afford to continue paying these premiums for a minimum of 10 years?
Aha. Okay.
And they're like, well, this ain't a get rich quick scheme here.
Right.
Okay. This policy may not be a good fit for you if you couldn't afford to pay the premiums for a minimum of 10 years. These are advanced policies, custom policies fit to an individual. But there are many places that an IUL does fit. And here's two common examples. Okay. Let's say you've watched our videos and we've always talked about maxing out all your other contribution limits. Okay. You got your 401k match from your employer, right? So they gave 3%. You went up to that 3%. You've maxed out your contribution there. Right. Next thing is step 2 is you maxed out your Roth IRA contributions for the year. Now, if you got remaining funds,
you go into this.
A good place to go is to into an IUL. And I'll tell you who fits this example are pilots, and because their incomes are much higher. Now, think about a pilot that we knew some that by September they've already maxed out their yearly contributions 401k. Inside their 401k. They can't go no higher, right?
Right.
Now they got 3 or 4 more months in the year of all this extra money. What do I do with it? Where do I invest it? How do I invest it? Mm-hmm. They're a good example of a person that this would fit, and their income would support continue paying into this type of policy for 10 plus years. So it does make sense.
All right. Also, what else? There are 2 examples. What's the other one?
Yeah, let's look at if you're helping to fund your child's education.
Right.
You can use an IUL to accumulate unlimited amounts of cash value and not be included in assets when applying for financial aid. There's a big one. So there's 2 scenarios where it does make sense for an IUL.
Okay. So I have a quick question. If I have to manage, the indices each year, which we just talked about, and I have to keep track of my policy myself. So you did mention there's work involved in this. Wouldn't it just make sense to buy a term life insurance policy and open up a Roth IRA?
And instead of an IUL, you mean?
Yeah. Yes. I'm sorry. Instead of
for the average person, yes, that makes sense to me, because you could look. There's no limits on the amount of earnings that you can get inside that Roth IRA tax free, right?
Right.
And if you honestly, if you come to my office and ask me to write you an IUL and this is what you want, you've already done all the research, this, that, and the other, and you haven't maxed out your Roth IRA first, what's the point?
Got it.
You missed a huge opportunity. If you haven't put the $6,000 or $7,000 that you're allowed to contribute to your Roth IRA for the husband and wife each, if you haven't done that for the year, what's the purpose of a IUL policy when I can just write you a very low cost term life insurance and max out your Roth IRAs for you with unlimited upside?
Okay. Got it.
So.
Makes sense. Thanks for answering that. All right. So is there anything else that we need to know about index? My gosh, indexed life insurance.
A lot of words, right? That's why I explained the 3 in the beginning. So honestly, Michelle, just know why you're purchasing it.
Yeah.
Please understand your purpose of why you're purchasing life insurance to begin with. What are you going to do with it? Is it just cover family expenses if you pass away prematurely? This is not your policy.
No, it's not.
Okay. And due to the high cost of whole life insurance, you may be a better off purchasing a term life insurance policy with a much larger death benefit, especially if your family's larger and you have to replace your income. So that's my thoughts.
Okay. So if you are watching this and you have a neighbor who has one of these policies, an IUL policy, really what needs to happen isn't, oh, I want what that person has, or that looks great. They're getting great, he or she they're getting great returns. It's more of what is the purpose of this?
Right.
And then go from there, work backward into what type of policy would be a best fit for you and your family in this exact moment.
Perfect.
Okay. All right. So if you like the content of this video, please hit that like button. We'd appreciate it. It helps us grow the channel and lets us know that you're enjoying what we're putting out. Also, if you have questions, not just about IULs, but any other type of life insurance policies, or as Brian mentioned earlier, even annuities, we talk about that, IRAs, drop them in the comments below. We're always answering questions that are left for us.
Yeah, definitely. We've had some great questions lately too. Thank you. Thank you, everyone.
Yeah. All right. Well, thanks, Brian. And thanks everybody for watching.
Have a great day.